So let's talk a little bit because you mentioned the expected move, and for us that becomes really important as we come into earnings season here.
Sure.
Earnings. You always want to kind of have an idea of that expected move, and as you mentioned, the options market is just great at kind of giving you a good sense of that move. Doesn't tell you direction, just tells you, hey, this is the move. It could go either up or down. So, but what we've certainly seen, especially since Regulation FD came out, and everyone has their quiet period. It's not as much of that nod, wink, wink. Here's what the earnings are going to be.
Of course.
Everyone's kind of getting this information, having to process. Okay, what should this be valued at now? And so you see all that volatility that happens after earnings. So what is your approach? Because you use
Well,
expected move so much, and this earnings announcement can really make for some big moves either way.
sure. And you're going to have a certain percentage of those big moves, whether it's usually around 5%, which is the 2 standard deviation, and usually there's some 3 and 4 standard deviations, which is the 1%. Um, but generally speaking, expected move is the most accurate statistic in all of finance. I mean, expected move is simply implied volatility. And as
Mhm.
long as as long as whatever the underlying you pick. So if you pick Microsoft, if you pick Apple, if you pick Google, if you pick Amazon, whatever it is, those are highly liquid underlyings that trade, 10, 20, 30, 50 million shares of stock a day. Their derivatives markets are basically 1, 2, or 3 pennies wide. The
Right.
expected move is the most accurate number we have in all of finance. And the expected move on a short-term basis, because of all the short-term options now, is the best thing that again, the best measure of what to expect. It's right about 70% of the time. And that 70%, by the way, is really 68 and change. It's a perfect distribution curve, what we refer to.
Uh-huh.
So it's not like I'm not just throwing out a number of 70%, but like the expected move in Tesla today was $20. And the
Right.
actual move, it looks like, was basically nothing. The expected
Which
move
is amazing. Yeah.
in Netflix,
Netflix.
the expected move in Netflix was about $40, and the actual move looks like it was so far. It looks like it's about whatever $20. The point I'm making is a lot of times, the expected move, it gives you an area of expectation so you can set up your strategy. The
Mhm.
expected move is basically just a great spot to give yourself like let's say you bought Tesla, just as an example. You bought 100 shares of Tesla and the earnings were coming out because you were bullish and you wanted to know, where should I place my sell order?
Mhm.
You place it at the expected move on the upside, which would have been $20 higher. Now it probably didn't get there, but that's where you would place your move because that's the optimal place given all the statistics that are available. If you were bearish on it, you were short the stock, you'd try to buy it in $20 lower. That's
Mhm.
all. It just gives you an area for setting up things. Like if you were an option trader, maybe you set up a strangle $20 higher, $20 lower. Or maybe you go 2 times the expected move, go $40 higher, $40 lower. But at least it gives you context so you kind of know what your probability of success is going to be.
Mhm. And so what kind of strategies do you use, during earnings season? Do you find that to be ripe for opportunity, or is is it a little bit tougher to play? I mean, it's
Earnings,
especially like last
yeah,
earnings season, it seemed like it was very hit or miss. Like they were either
earnings
up a lot or down a lot.
earnings have the least amount of edge of
Okay.
any trade you can make, the least amount. So
Mhm.
if you go out to a longer duration, you have a lot more potential edge because there's a lot of things you can do. You can adjust the trade, you can tweak it, you can make different adjustments along the way. With earnings, it's basically a binary event.
Yeah.
Like it's an overnight event and there's very little you can do. And so with earnings, statistically, you have the least amount of edge. They're essentially a pure theoretical play. So if you have something with a 50% probability of profit, it's 50%. If you have
Mhm.
something with a 72% probability of profit, it's 72%. But if you did something with, let's say, 40 days to go with a 72% probability of profit, it'd be closer to 80. So you
Mhm.
have edge if you go out longer. It's just a function of time. Duration gives you time to do things. Overnight binary plays, and it might not be earnings. It might be a Fed number. It might be
Right.
and it might be an economic number.
Mhm.
All of those, all of those binary events have the least amount of edge, but people love trading them because it's instant gratification.